Hey everyone, welcome back to Corporate Decoder, the place where we uncover the juicy financial secrets hidden in plain sight. And trust me, this latest filing has some spicy details about investor income. Get ready because Western Asset High Income Fund II Incorporated latest report is out, and it is a deep dive into how this fund plays the market with its investors' money. This document is basically the fund's yearly checkup report, filed with the SEC, and it is packed with numbers and important risk warnings that tell a lot about their strategy. This is Western Asset High Income Fund II Incorporated, and they're a closed-end management investment company. Think of them as a company that pools money from investors to buy a bunch of different things, mainly high-yield debt securities. Their main goal is to make as much money from income as possible, with a side goal of growing that money over time. Their game plan is pretty direct. They want to get you income. And if they can grow your money a little on the side, even better. But remember, there is no guarantee this will always happen. Now, here is where it gets interesting under normal conditions. At least 80% of their money, plus any borrowed money, goes into these things called high-yield debt securities. These are often cold junk bonds, and they might be rated really low, like a C by Moody, S or D by S&P. You get them because they often pay a higher interest rate, but they come with a much bigger risk of the company not paying you back. And to spice things up even more, they can put up to 35% of all their assets into debt from countries that are still developing, known as emerging market countries. This adds a whole new layer of risk, from political instability to currency swings. Let's look at the numbers from their financial highlights. As of the 30th of April 2025, the net asset value per S-share was $4.26. Now, what is net asset value or NAV? It is essentially what each share of the fund is worth based on the value of all the investments it holds, minus its debts. On that same date, the market price, which is what you can actually buy or sell a share for on the stock exchange, was $4.08. Notice the difference. NAV was $4.26, but you could only sell it for $4.08. That is a discount, and it happens a lot with closed-end funds. You are buying a piece of a portfolio, but the market price can be lower than what those underlying investments are actually worth. Their total return based on NAV for the year ended the 30th of April 2025 was a positive 8.11%. That's pretty decent, meaning the underlying investments grew in value and paid out income. But look at the total return based on market price. It was only 7.52%. Why the difference? Because the market price was lower and you were selling at a discount. So even though the fund's investments did well, you as an investor might not have seen all of that gain because of the market S valuation. Now, let's peek at their leverage strategy. They use borrowed money to try and boost returns. As of the 30th of April 2025, they had $157 million in loans outstanding. Their asset coverage ratio for these loans was 344%. This ratio shows how much asset value backs up their debt, and 344% is generally considered healthy, meaning they have more than enough assets to cover their debts according to the rules. This brings us to fees. The management fee is 1.18% of their managed assets. Managed assets include their actual assets plus any borrowed money. So, using leverage, which they do, increases the pot of money that the management fee is calculated on, meaning the managers get paid more. And then there are the interest payments on those borrowed funds, which comes out to a hefty 2.72% annually. So you have management fees and interest costs eating into your returns. All combined, the total annual expenses are 4.03% of their net assets. That is a significant chunk to overcome just to break even. Think of it this way: if your investment only grew by 4%, you'd essentially be making nothing after expenses. Now for the risks, they emphasize investment risk and market risk, which is a fancy way of saying the value of your investment can go down, and you could lose all the money you put in. Remember those high-yield debt securities they invest in? They're called high yield for a reason, but that high yield comes with a high risk of default. If the company they lent money to can't pay it back, the fund loses money. This risk is especially high for these types of bonds. They're also investing in emerging markets, which means they're exposed to foreign risks. This includes everything from political changes and economic instability to currency fluctuations that can make investments worth much less when converted back to US dollars. And then there is leverage risk. Using borrowed money amplifies both gains and losses. If their investments do well, leverage can boost those returns. But if they do poorly, leverage makes those losses much, much bigger. They even warn that it could lead to the loss of all of the fund's assets. They use leverage specifically to try and give investors more income. But as we've seen, this also ramps up the risk. Looking at their senior securities, which is basically their debt as of the 30th of April 2025, they had $157 million outstanding under a revolving credit facility. Their net assets attributable to common stockholders, meaning the total value of the fund that belongs to common stockholders, was $384 million at the 30th of April 2025. Now, this whole document is about their common shares, which is what you can buy and sell. They've got a lot of different disclosures about these shares, all of which are designed to tell you exactly what you own and what risks you're taking. For dividends and distributions, unless you actively opt out, they will automatically be reinvested into more shares of common stock. This is often done through a dividend reinvestment plan. On the bright side, it can mean adding to your investment without extra transaction fees. But here is the kicker: even though the money is reinvested, you still have to pay taxes on those distributions as if you received them in cash. This filing is also talking about a potential new offering of up to $185 million in common stock, and also subscription rights. This means they might sell more shares, which could dilute the value of existing shares if not managed carefully. They even mention that rights offerings can sometimes be priced below the net asset value, which might sound good, but it can also signal that the market isn't valuing the shares as highly. They've been paying monthly distributions since they started, which is attractive for income. Seeking investors, however, they explicitly state that these distributions might not be from profits. They could be a return of your original investment, which lowers your cost basis and could mean higher taxes later when you sell. So, what looks like income now might end up costing you more in taxes down the road. Ultimately, this fund is geared towards generating current income from a portfolio of higher risk, high yield debt. Often in emerging markets, they use leverage, which can amplify returns but also losses. The NAV per share has fluctuated, and the market price has often traded at a discount to that NAV. So, what is my take on Western Asset High Income Fund the SU incorporated from this filing? This is a fund that aims for high current income, which is appealing. But it comes with significant risks. They are investing in riskier assets like high yield debt and emerging markets and using leverage. This strategy can work well in certain environments, potentially delivering attractive income. But it also means that when things go south in the economy or in these specific markets, investors could see substantial losses. The fact that the market price often trades at a discount to the net asset value is a red flag for some, suggesting investors might not be valuing the underlying assets as highly as the fund managers do at certain times. When you combine the high fees and the inherent risks of their chosen investments and leverage, it is crucial for potential investors to understand that this is not a set it and forget it kind of investment. It is for those who can tolerate higher volatility and risk in exchange for potentially higher income streams, and who understand that capital preservation isn't their primary goal. Income generation is. One notable area of risk they highlight is related to the Maryland Control Share Acquisition Act, or MACSAA. They've opted into this, and there is a legal debate on its enforceability, which could create uncertainty for shareholders, particularly concerning control of the fund. It's a complex legal dance that could impact shareholder rights. So, if you're looking for high income and you understand and can handle the associated risks, this fund might be something to look into. But do your homework, read all the fine print, and consider consulting a financial advisor. What are your thoughts on this fund strategy and its risks? Let me know in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe to Corporate Decoder for more deep dives into financial documents that matter. And don't forget to join our Discord community, linked in the description, to keep the conversation going. Thanks for watching, and I'll see you in the next video.